Hey guys, it's Mrs. Invest. How are you doing? I hope you are doing so well. Yes, I'm in the new place. Hopefully everything's good with the lighting. Let's get right into the video. I've really missed you guys and I have a good one for you today. So let's say you're a Canadian and you really want to invest in a particular US stock. Let's say Tesla stock for an example. You love the company, you really want to be an investor, but you have $1,000 Canadian to get started with. This isn't gonna work because if you wanna buy Tesla stock outright in US dollars, it's gonna cost you over $1,100 per share today just to buy one share of Tesla stock. And an ETF isn't really gonna work because you only wanna buy Tesla stock, but through an ETF, you're gonna have to buy, hundreds of other stocks within the ETF just to have, a tiny percent ownership of Tesla. So this is really where I think the benefit of CDRs come in. I think this is a really common scenario. A lot of the popular US stocks have a super high price per share, and it makes it really unaffordable for the average Canadian retail investor to get started investing with them, especially when we're starting out with a smaller amount of money, and the fact that the Canadian dollar is weaker than the US dollar certainly doesn't help at all. So this is where Canadian Depository Receipts come in, or CDRs, and it's Canadian Depository Receipt, not suppository receipt. Let's just clear that up right from the beginning because I literally heard someone call them Canadian Suppository Receipts like a few days ago, and I really hope it was a joke, but I feel like it wasn't. And anyways, just don't call them suppository receipts, okay? Essentially, Canadian Depository Receipts allow Canadians to invest in foreign stock using Canadian dollars at a more affordable price, at a lower price per share through fractional ownership, and reduce the risk of currency fluctuations. So I know that was a lot, but let's break it down exactly what CDRs are, what their benefit is to us as Canadians, and how they can help us invest in foreign companies in a little bit of an easier and less roundabout way, especially for beginners who are starting out with a lower amount of capital. Now, just to be clear here, in this video, I am not, for CDRs or against CDRs or trying to convince you one way or the other to invest or not to invest in CDRs. Like, that's never my goal on this channel. A bunch of you guys have commented on previous videos asking me to do a video on CDRs, and I think it is a great video topic. So, you ask and here I am delivering. But my goal here is really just to provide you all the information that I know about CDRs that I think are relevant so that you guys can learn more about them, be better informed, and make a decision for yourself if you think they're right for you to invest in or not. So with that said, let's get right into it. What are Canadian Depository Receipts? So what is a Canadian Depository Receipt? You can think of it as basically the exact same thing as you going out and buying shares of stock of a foreign company. And in this video, when I say foreign, this can mean any country in the world outside of Canada, but to simplify it, when I say foreign, let's just think US, because typically as Canadians, that's kind of like the first place that we look to invest in outside of Canada. But there are three very special things that make CDRs and differentiate them from you just going out and buying shares of Apple stock in US dollars, for example. Number one is that CDRs allow you to invest in US stocks with Canadian dollars. Now, typically, if you want to buy US stocks in the normal way, you have to convert your currency and open a US dollar trading account, which is kind of the standard way to do it. But CDRs allow you to invest in these very same companies using Canadian dollars. So that's really one of the benefits of them. The second is that they're currency hedged. And so what this means is that the fluctuation in currency, the difference between the Canadian and US dollar, the Canadian dollar fluctuating up and down relative to the US dollar, that risk is eliminated and it's accounted for through purchasing the CDR. And so the return that you're going to get from, let's say, for example, investing in Apple stock through a CDR is you will get the return of Apple, the company, for the period of time that you've held that share, compared to if you buy Apple stock directly in US dollars. Part of your return will be affected by not only how Apple performs, but also how the difference in our country's currencies are how they're moving in relation to each other. So it kind of eliminates that extra factor and just allows you to focus on the return of the actual company. And the third thing that makes CDRs, which is what I think to be the biggest benefit of them compared to the previous two, are that they offer fractional shares. Every time a CDR, a new one, is introduced, it starts at about $20 per share Canadian, regardless of how expensive that US stock is trading normally. So Tesla stock was introduced at around $20 Canadian, even though it trades now at over $1,000 US. And let's say Visa stock was introduced at around $20 Canadian, even though it was trading at around $200 US. So they split up the shares and whittle them down. So basically each time they're introduced a new one, it's about $20. And this really makes some of these super expensive companies way more affordable for the average retail investor. So if I had to round that all up to explain what is a CDR in a single sentence, I'd say it's an affordable way for Canadians to invest in foreign stocks or US stocks through fractional ownership, while at the same time adjusting for currency risk between the Canadian dollar and the US dollar or the Australian dollar or whatever foreign stock you want to buy through the CDR. And this is not a new concept. ADRs, or American Depository Receipts, have existed for quite a long time to help Americans buy stock in foreign companies such as, let's say, Japanese or other countries. So what can you buy using CDRs? Now, at first there were only a couple stocks that were put out through CDRs, but they seem to be constantly adding new stocks. And the ones that seem to be the most popular are the ones that you would probably think to be the most popular, which are some of the big name stocks on the US stock market. And I'll put a chart up here so you can see, but we're talking about Amazon, Google, Alphabet, Tesla, Netflix, stocks that cost often hundreds to thousands of dollars per share US, which makes them largely unaffordable for the average Canadian retail investor. And as well on that chart, you can see the price that they're trading at and how they're all in about the $20 range. So there's a huge difference there on who is able to invest in Amazon stock just based on the entry price that the CDR creates. And some of these popular US companies are so expensive to buy just one share. Alphabet, almost $3,000 US per share. Amazon, well over $3,000 US per share. Netflix, $600 a share. Apple is only $140 a share, but it's split like a bajillion times. Tesla now is $1,100 per share. So if you sought out to just buy one single share in, a few of these top companies that I've mentioned, you would be looking at spending over $10,000 Canadian just to buy a single share of these individual companies. And while you could do it, it kind of makes it hard and a little bit honestly demoralizing when you're just starting, because you're like, wow, I have 10,000 Canadian and all I can do is buy a single share of each of these individual companies the normal way. So you might be thinking, well, why invest using CDRs? And I think the core of the answer here is, well, without CDRs, how would you be able to invest in these foreign US stocks? So what you have to do is you first have to open a US dollar trading account, and then you have to somehow acquire Canadian dollars, and then you have to take those Canadian dollars and do currency conversion to transfer them into US dollars into your US dollar trading account, and only then can you buy US individual stocks. The more money that you have that you're transferring into US dollars, it makes it more worth it to just do that original step. But let's say you don't have, tons and tons of money that you're willing to transfer into US dollars. Then what? Are you basically just stuck having to invest in Canadian companies because it's just simply doesn't make sense to, spend the money on currency exchange to be able to invest in US dollars? So this gray area, I think, is where CDRs are kind of interesting. So what exchange are CDRs listed on? Well, they're listed on the NEO exchange, NEO. And you might say, well, why aren't they listed on the TSX, the Toronto Stock Exchange, if they're traded in Canadian dollars? And I looked into this, and honestly, I don't really know. The only answer that I could find was that they wanted to be part of a more innovative exchange, and they thought that NEO was an innovative exchange. There has been some criticism about the NEO exchange being sort of a newer exchange and concerns about liquidity. That seems to be people's most frequently cited concern. And by liquidity, it means, if you want to sell, will there be a buyer? And if you want to buy, will someone be there selling for you? So normally markets are very liquid during trading hours, as long as your order is not like billions of shares. If you want to sell your shares, they will get sold instantly at market price. But from the people who are actually owning CDRs, I haven't heard anyone complain that they were never able to buy when they wanted to buy or sell when they wanted to sell. So it seems to be mostly people who concerned with liquidity who don't actually own CDRs. So take that for what you will, but they're listed on the NEO exchange. So what about fees for CDRs? When we buy individual stocks, there's no fees outside of the commission to buy or sell. Of course, when we're thinking about ETFs, they have MER or management fees. No one is going to give you fractional shares, currency hedging, and removing the annoyance and hassle of having to trade in US dollars for free, right? So from what I could find, CDRs don't have a listed MER. There's no management fee per se. These people who are making the CDRs have to make their money somehow. And through a little bit of digging, I discovered that they make money off of the currency hedging that they provide, and through a lot of digging, I found that it works out to about 0.6% of an effective MER. So although it's not a management fee, they are profiting somewhat on the currency hedge through providing the CDR. So what about dividends that get paid out by these foreign companies normally if you own shares of their stock? So for example, Apple pays a small dividend, Microsoft pays a dividend, many US stocks pay dividends. Now, what happens is you will still get your dividend proportional to how many shares or fractional shares that you own. And the dividend gets paid out through the CDR in US dollars, and the CDR processes it for you and gives it to you in Canadian dollars. Now, although it's in Canadian dollars, you do not get to claim the Canadian dividend tax credit because the underlying asset is American, it is foreign, so there's no sneaky tricks you can play there. You are not able to claim any dividend tax credit on the dividend, but it does come to you in Canadian dollars. And what about taxes on CDRs? So when you buy and sell them just like normal stocks, the profit or loss will be considered a capital gain or a capital loss, just like buying and selling any stocks, whether Canadian or foreign. And when it comes to the dividends, you will have to pay the foreign withholding tax if you hold the CDR outside of the RSP and it does pay you a dividend. And the dividends will still be taxed as foreign dividends again, although they are being paid to you in CAD. Okay, now I want to talk about currency hedging a little bit, just in case you don't know what that is, you're not familiar with it. And that again was the second thing that I talked about that makes a CDR a CDR. So when you buy a Canadian stock in Canadian dollars that trades on the Canadian Stock Exchange, your return of that investment depends solely on how that stock did for the period of time that you held it. So for example, let's say you bought a stock that was $100 a share Canadian and the stock went up 10% that year. Your stock would now be valued at $110 and you would have made 10% on your investment. But let's say you bought a stock on the American Stock Exchange that cost $100 American, and that same company increased in value by 10% that year. So the stock would now be worth $110 American. But let's say the Canadian dollar that year, over the period of time that you held that stock, went down. If the Canadian dollar weakened relative to the US dollar, then you would have actually made more than a 10% return on your investment, not because of the performance of that underlying asset, but simply because of the fluctuation between the Canadian and US dollar. So I know it's a little bit confusing to think about, but if the Canadian dollar goes down relative to the US dollar and you are holding a stock in US dollars, then you have made more than the performance of that stock that year because the Canadian dollar went down. And on the other hand, if you bought that same American stock for $100 US, but the Canadian dollar got stronger relative to the US dollar over the time that you held that stock, then your return would be lower than 10%. although the company performed at 10% over the period that you held it, because the Canadian dollar got stronger relative to the US dollar, your return would be less than 10%. So you can see here that when you are buying shares of stock in foreign currency on their foreign currency exchanges, your return is not only dependent upon how that asset performs, but it's also dependent on how your home currency fluctuates in relation to that foreign or US currency. And so CDRs eliminate this risk, so you don't have to be affected by the currency fluctuations. Your return is only dependent on the performance of that underlying asset. So how do you purchase CDRs? Well, in this way, it's really simple compared to buying the underlying stock. Of course, you have to have a brokerage account open, a trading account, whether that's a self-directed TFSA, RRSP, and non-registered. And yes, you can buy them in any of the 3 accounts. And you have to fund that account with Canadian dollars, and then you place a trade, whether it's a market order, a limit order, etc. And so in this way, it's really similar. There are only a few differences that you'll notice when you're placing the trade, and I'll go through a mini tutorial with you and show you that now. So here I am on my online brokerage. This is CIBC Investor's Edge, but pretty much applies to whatever brokerage you're using in Canada. So you're going to type in the symbol. Let's use the example of Microsoft. So you can see here Microsoft US, Microsoft ordinary shares. This is Microsoft listed on the US market in US dollars. And if you click on it on the right here, you can see it's $343. And that's what Microsoft trades at in the US. Another giveaway that it's on the US market is it says here US. So let's go back to here and do that again. And you can see here, Microsoft Canadian hedged CDR. So if we click on that, you can see it's trading around $20, and you're looking at the CDR here because it's an American individual stock under a Canadian dollar trading, and especially that it's around $20, you're dealing with a CDR here. So, you buy however many you want, just like you would a regular stock. Let's say 100 shares at market order, expire for the day, and you put your order through, and that's how you buy a CDR. It's exactly the same as buying regular stocks. The only thing you need to do is, if you're typing in the ticker of a US stock, you click the Canadian. Oh, this one says depository receipt. Microsoft said, what did it say? Canadian hedged CDR. So as long as you know what you're looking for, you'll be able to find it. But American stock with a Canadian flag or a Canadian symbol, that's a CDR. So with all that said, what's my opinion on CDRs? Like I said at the beginning of this video, I'm not biased towards or against them. I just want to make a video informing you guys about them in case you hadn't heard about them or you had heard about them and you wanted more information. But, of course, my opinion doesn't really matter, but in case you're curious, at the beginning, I did mention those 3 things: that they allow you to be purchased in Canadian dollars, that they're currency hedged, and that they're fractional shares. The fact of being able to purchase them in Canadian dollars, I would say, is a convenience at most. It's really not a necessity. The more money that you have to devote to investing in foreign companies, the less of a benefit I see. When it comes to currency hedging, the overwhelming evidence is that the longer you hold the underlying asset, the less of an effect the fluctuation in currency becomes, meaning AKA over the long term, currency hedging really doesn't matter. And when you are thinking of currency hedging, especially when it comes to CDRs, this is where you're sort of paying that pseudo management fee of 0.6%. So for something that probably doesn't matter in the long term, is the currency hedging worth it? I don't think really, but it does maybe provide you some peace of mind, I guess, if currency hedging is something that bothers you, but I honestly never think about it. And the third criteria, which is that they offer fractional ownership. In my opinion, this is the main benefit of CDRs, because I think there are a lot of people who want to be able to invest in certain US stocks. They don't want to buy a whole ETF. They don't want to buy the S&P 500. They don't want to buy the US total market. Let's say, especially now, everybody wants to buy Tesla stock, right? If it comes down to not investing in a stock that you really want to buy because it's just way too expensive in the foreign US currency, or buying a CDR so that you can get into it for around $20 Canadian a share, I definitely think that's a huge benefit to CDRs that shouldn't go unnoticed. So for me, this is really like the golden nugget of CDRs, is that fractional ownership and lower barrier cost of entry. So I hope this video was helpful for you guys and maybe that you learned something. Let me know what your thoughts are on CDRs. I'd love to hear your opinions, especially if you're invested in them. I don't own any personally. I just own my US stocks outright in US dollars. But as always, I'd love to hear your thoughts. You can follow me on Twitter at Mrs. Invest1, and I will see you guys in the next video. Bye.